Welcome back to another Meet Kevin report. We are on episode 98. Today is a jobs report day. This is probably one of the two big numbers that we're looking for and have been waiting for a hot minute here. Mostly because everybody wants to know what the heck the Federal Reserve is going to do. Is this actually going to be the time the Federal Reserve finally pivots or U-turns? What do you call it? And that tends to be a big deal these days. Is it a pivot? Is it a U-turn? One's good, one's bad. Is this going to be that time where the Federal Reserve finally goes to pause? It seems to be the answer to that is yes. It seems to be that this is the time the Federal Reserve is going to trend towards pausing, mostly because that's exactly what they're leaking to their buddy Nick T over the Wall Street Journal. And he's the one who basically was just responsible for the interest rate monitor looking forward for what we think is going to happen or what the market thinks is going to happen for Fed rate pricing, flip-flopping back to pause. That is, we had been getting some data that somewhat led the market to say, hey, we think there's a slightly greater chance the Fed needs to keep going and keep raising rates, that we're not done at 5 to 5.25, and instead we need to get to maybe 5.25 to 5.5 or 5.5 to 5.75. Really took a little bit of a leaky doodle over to Nick T from the Wall Street Journal, and finally, the market's like, okay, yeah, you know what? We're okay with a 75% chance of a pause. Now, the Fed generally does what the market expects, but you wonder what comes first, the chicken or the egg. If the Fed generally does what the market expects, but the Fed guides that by telling the market what to expect, then the Fed really just gets what they want. But by pre-leaking it, they take some softness or they take some of the shock of what's going to happen at the meeting away from what's going to happen at the meeting. And instead, they put that, they get to sort of preview, okay, how's the market going to respond if we do pause? Are we going back meme stock world to the moon, or is the bond market going to be stable? Are inflation expectations going to take off? What's going to happen? And so it gives them a few days to evaluate this. And in this case, it gives them more like 2 weeks to evaluate exactly what's going to happen. And those, I should say that time frame is essentially playing out now. For the last 2 days, the Federal Reserve has essentially reiterated, let's pause, subject to the next two data sets coming out, one of which is today. And then, of course, we will see what happens with inflation right before the Federal Reserve meeting on the 14th and 13th. So you've got the next catalysts are today, jobs report, which comes out in about 6 minutes. We'll get an indication of what the United States payrolls data is. Yesterday, we got a hot ADP report, which gave us a leading indicator that, hey, maybe, just maybe, the market isn't slowing down as much as people think. And that's often because, a lot of people, I think, are under the impression that, a recession, it's got to be here soon. And if it's not here soon, then it's certainly going to be here next quarter. And it feels like the recession has been 1 quarter away for the last 6 quarters. And quite frankly, it's probably going to be another 3 or 4 quarters away if it comes at all. Economists still widely believe it's going to be in Q3, Q4. I don't know about that. Right now, we're already in the last month of Q2, which is kind of weird to say that we're already in the last month of the second quarter of 2023. What the heck happened to the year already? I feel like it's just gone by so crazily. It's pretty remarkable. So, no, I guess we'll find out. Jobs report, again, within the next 4.5 minutes here, we'll get the data release on jobs. And then we will get our CPI release, inflation release on the 13th. We'll get the Fed on the 14th. And quite frankly, if both of these come in, I guess if you put it this way, if the jobs report comes in strong and the wage gain comes in weak on the jobs report, which we'll get today, and then the inflation report comes in weak, and that comes on the back of a strong jobs report, there's no reason why, and the debt ceiling's done, there's really no reason why the stock market should not continue its Nike swoosh recovery. Now, I know people are like, Kevin, stop it, okay? We get it. You've been talking about the Nike swoosh recovery now for like a long time. And yeah, it's been playing out. But don't worry, the earnings recession is coming, say the bears. It's interesting because every time I look at earnings reports, I seem to be looking at companies that are already in an earnings recession. Look at companies and go, oh, wow, your net income's down 30% year over year, or 5% year over year, 10% year over year. And it's for 2 quarters in a row. Technically, 2 quarters in a row of negative growth is a recession. And if you're referring to earnings, you're in an earnings recession. If you're referring to revenue, you're in a revenue recession. If you're referring to GDP, you're in a recession. It's like you had different kinds of recessions here. It's crazy. But what's also crazy is that I have not seen this before. The Dow, the S&P, and the NASDAQ are all literally up about 45 basis points right now. Technically 44, 43, and 45, but all within like 1 BP of each other. That's bizarre. Mostly it's bizarre because lately the Dow has been lagging the S&P, which has been lagging the NASDAQ. In fact, as of just a few days ago, the Dow was negative for the year. The S&P was up 10% for the year. The NASDAQ was up 32% for the year. I think ARK was up like 20% for the year. And then there are other, trades that are up even more than that. Some are up 40%, some are up 50%. It's just wild. Anyway, all right. So here's what to expect for jobs data in the next 2 minutes. The market is presently expecting a survey result of 195,000 non-farm payroll release status, whatever, 195,000 jobs. Private payrolls, 168,000. Then we're looking at unemployment rate is expected to tick up from 3.4 to 3.5%. We're looking at average hourly earnings, which we expect to come down from the prior read of 0.5%, which annualizes out to like 6%, which is way too high. We're looking at to come down to 0.3%, which annualizes out to 3.6%. Keep in mind the Fed's goal is 3%. 0.3% annualizes to 3.6%. So if you started getting reports that were like 0.2, 0.3, 0.2, 0.3, that would actually be good. That's all you would need wage growth to go to, and you could still have wage growth while having 2% inflation, or at least movements that were consistent with this. So who knows? But what we will find out is how recessionary the current market is. Some people say, well, who cares about this data? You got a lot of seasonal job hiring that goes into the summer, especially in leisure and hospitality. And then after that happens, then the recession will come. Okay, I guess we'll find out. Anyway, the report comes out within the next 30 seconds now. I myself and the team, after we got back from New York yesterday, did not make it at changing the prices for the courses on Building Your Wealth yet. So we're going to do that today. I'm going to get my videos posted, and then we're going to sit down and knock it out. It's crazy. It takes like 90 minutes. Now, sometimes it takes even longer to do it. It's super manual because you have to do all the bundles and stuff. Anyway, so you can still, at least at this moment, just today, but that's just a time frame. Okay. Oh my God. Change in non-farm payrolls comes in at 339,000. That's a massive beat. You've got, we don't have the wage gain number yet. The unemployment rate, what the hell? It goes up to 3.7. How do you have, the participation rate labor force participation rate. Oh my God. What is it? What are these numbers? Labor force participation rate, 62.6. So that's a match on expectation. It's the same as the prior. The average hourly earnings are 0.3%, so it's a match. The average hourly earnings year over year are 4.3%, which is weaker than expected on the year over year number. What the heck? But your change in non-farm payroll is this insane beat of 339,000 versus 195. That's a 74% beat, but the unemployment rate actually goes up. The unemployment rate goes up from the prior of 3.4 or the expectation of 3.5 to 3.7. with a massive beat in the change in non-farm payrolls. I mean, like, now it's just like, what data is this even anymore? Like, what is happening? Is this like, who's cooking the books, basically? This is quite bizarre. Okay, so we'll go through the exact report in just a detail in just a moment, but let's see what some of the initial things are here. Third whopper number of the year. At the start of 2023, economists were expecting the January jobs figure to come in at 189,000. We got a print of 517,000 instead. Here we go. Wow, another big surprise. Yeah, no kidding. But at the same time, the unemployment rate rises 0.3%. Is this the Fed's interpretation of, oh, the unemployment rate is going to go up while massive jobs are being created? What? This is so weird. Okay, so again, this is now the third crazy beat in a row. Let's try to understand what's actually in this report, because this is quite bizarre. Non-farm payroll increased 339,000 in May. Yeah, this is going to be tough for the Fed. Going to be hard to pause after such a big gain in payrolls. I don't know, though. The average hourly earnings came in at forecast. Remember, I don't know that the Fed needs to cause unemployment. I think people keep thinking that. People keep thinking the Fed needs to cause unemployment. They don't. And in a weird way, they kind of just did cause unemployment by the unemployment rate going up 0.3%. This makes absolutely no sense at all. Okay. 339,000 jobs in May. The unemployment rate rose 0.3 percentage points to 3.7%. I don't understand. We'll figure it out, though. Household data rose. Let's see. Unemployment rate increased. Okay. Unemployed persons rose. Oh, here you go. And in the households data. So in the households data, the number of unemployed people rose by 440,000. Okay, so that's interesting. So in the payrolls data, you had a 330,000 gain, and in the household survey, you had a 440,000 job loss. Am I to understand that correctly like this? But we will get through the charts, and they'll show us this in a little more detail. All right. Unemployment rate for adult women, 3.3%. Blacks, 5.6%. Adult men, 3.5%. Whites, 3.3%. Asians, 2.9%. Hispanics, 4%. Little changed. Number of job losses and persons completing temporary jobs increased 318,000. Number of persons jobless less than 5 weeks edged up by 217,000. So if I'm to sort of put little negatives here, that's an increase right here. That's an increase right here. That's an increase right here. So you got some negative numbers, and these all seem to be on our household surveys data, which, remember, the payrolls data is calling businesses. So this is from the business point of view, which basically can double count people. So if you have multi-jobs, you could get double counted in this survey, whereas over here, you don't get double counted. The 2-year treasury yield, by the way, serving now. Oh, great. And April gets revised up. Hold on a sec. Let me look at this. This is, oh, yep, of course it does. Oh, wow. This is very fascinating. Okay, so change in non-farm payrolls for the last month goes from 253,000 to 294,000. So you get a revision up of how many jobs you had the last time. But then, wait for this. You ready for this? The average hourly earnings of the last report actually went down from 0.5% to 0.4%. So in other words, in May and April, we had weaker wage growth than expected. We just had more jobs than expected. That's quite literally your Goldilocks scenario. It's quite literally going to make Jerome Powell very excited. Jerome Powell's going to be like, oh, I'm getting inflation down while people are getting more jobs. I mean, come on. If you were the chairperson of the Federal Reserve, you'd be feeling the same way. You'd be like, I'm about to get a statue at Mount Rushmore. Okay. Labor force participation rate didn't change, 62.6%. Number of persons employed part-time at 3.7. Little change. Number of persons not in the labor force, 5.5 million, little different. Not attached was a little changed. Fine. Establishment survey. So here's your establishment survey. Total non-farm payroll increased 339,000 in May. That was the headline number we read off, whereas we had those losses over in the household. What do we have here? You've got in May, professional business services added 64,000 jobs, similar in April. Government employment, 56,000. Healthcare, 52,000. Leisure and hospitality, 48,000. Construction, 25,000. Transportation and warehousing, 24,000. That's actually surprising. Let's see. Couriers and messengers up. Air transport up. Social services up. Employment little changed at other industries like mining, oil, gas, manufacturing, wholesale trade, retail trade. No, I see no losses here, at least in the establishment survey. Average hourly earnings, here you go, 0.3%. That's actually really good. But both of these numbers, the 0.3% at expectations, the 4.3%, slightly lower than expected. Most Fed officials, crucially Powell, have been saying that they're ready to pause, perhaps skipping a rate hike. The whole skip is such BS. If they pause, they pause. I really don't believe this skip narrative. It doesn't make sense. You go back to the Arthur Burns reputation of start, stop, start, stop, start, stop. It's not what they're going to want to do. Yeah, wild. This is 14 straight months, by the way, that payroll gains have beaten the median estimate. Wow, 14 straight months. And it's not the first time in a period that the number has beaten every single forecast. The highest forecast this cycle was 250,000, and 339,000 handily beat that, especially since the prior 2 months in total. So last month was revised up like 40,000 jobs or whatever. And the month before that was also revised. In total, those 2 months revised up 93,000 jobs. This is nutty. This is very, very wild. Well, it's good, but it's just wild. It's not what you would expect. Let's get some of these tables up here so we could get a little bit detail. But oh my God, this is insane. Okay, so let's look at the households data. It's good. It should be good. The market should be seeing this as a good thing. But we'll look at just a moment. So here you have the household survey, household data, and you have, let's see here, employed. Wow, look at this. This is why the unemployment rate went up. So in the household survey, employed minus 310,000. Unemployed up 440,000. So we have to think about this at the same time as wages aren't going up. So really that much. What's happening here is you're probably seeing, let's take a look here, household data, which again reports on individuals. Individuals. Nobody really cares how you spell it, Kevin. Just get to the point. Minus 339,000. Do I have that correct? Minus 310,000. Okay, fine. Minus 310,000 jobs. That's the household data. The payroll or the establishment survey reports on businesses. That's kind of like, yo, business, how many people you got on payroll? That actually shot up by 339,000. And then the number of unemployed shot up by 440,000. So this is soft, right? So Fed working. This is soft, Fed working. This is stupid. And then, and then the 0.3% wage gain month over month is good. The 4.3% year over year is lower than expected. And last month over month, went down from 0.5 to 0.4%. And I don't suppose I would argue that the data is rigged, but I suppose if I were going to rig the data, it would look something just like this. Okay. Wow. Very interesting. So let's see here. Job gains have averaged 314,000 this year. 470,000 since 2020. In the 10 years before the pandemic, employers added about 187,000 on average. So this is the 14th straight beat on average since what is this? On average since pandemic, or 10 years since pandemic, 10 years prior to pandemic, 187K average. Wow. This is remarkable. Now, I'm curious to see what effect this actually has on some of our markets. So, well, let's look at exactly that. Here's your NASDAQ. Look at that volume, first of all, coming in right here. As the data comes out, at first, you get this massive dump, and then you get a recovery, and then you get a dump again. So you're at about 0.3%. You're down about 15 basis points from where you were before the report on the NASDAQ. If you look at the SPY, you're at 422. You're at a FIBI level. The SPY is basically like, oh my God, this is terribly great. The SPY is actually up like 8 basis points. Tesla's up 1.3%. You've got Okta, up 1.3% after that like minus 20% day it had yesterday. Yeah, okay, minus 17.8%. C3AI is up or down 13% yesterday, down another 2% today. What's this? Carvana, crazy, like 22% yesterday. Redfin 6% yesterday. Nvidia 5% yesterday, up 0.8% here in pre-market. Embraer was up 4% yesterday. Wow. Okay. So what about DJI? Every time I type DJI for Dow Jones Industrial, I'm like, drones? Okay. Fascinating. So let's now, let me see what else Wall Street is saying here. Other than Kevin still needs to raise the prices on the courses, so you still have a few hours left of checking out on any of those programs, or send us an email. We've already caught up on all the emails, but if you wanted to fill the team up again, you could do that. Email us at staff@meetkevin.com. But I will get it taken care of after I get my work done this morning. So anyway, Bureau of Labor Statistics notes that employment gains in May came in these sectors: business services, government, healthcare, construction. We already went through that. Okay, what is this? Here's an industry breakdown. I don't really care about that. We already went through. That's stupid. I don't care. Okay. Oh, treasuries. So what's going on with treasuries? And then we need to see in a moment what's going on with the 5-year break even. The 5-year break even lags a little bit, so we'll go to that in probably a few minutes. But this is just insane. Okay, so treasury yields technically up a little bit. I mean, like the 10-year treasury is up like 4 bips. Who cares? It's at 3.64%. The treasury yields, in a weird way, are actually popping. They were trying to pop off a little bit. We don't know if that'll actually hold, but I can't say that like a 4 bip rise on the 10-year treasury is that big of a deal. It looks like a big deal, but that's because I'm looking at a day chart, and I'm literally looking at a chart going from 3.61 to 3.64. Like, who cares? So that's not a big deal. This is so weird. This is quite bizarre. What are they saying here? I mean, I wonder if they're just equally confused. Oh, the second I go to them, they go to commercial. Hey, you bastard. Okay, let's try Bloomberg then. Weird.
Areas of the economy in terms of hiring. That's a little bit worrisome for the Fed and the inflation, because all the disinflation is coming from the goods. And so if goods prices are stabilizing and goods hiring is increasing, which is what we see in this report, then you may have the consensus outlook here, which is focused on these NAPLM surveys, the PMIs, we got it earlier, the ISMs, collapsing into recession levels. That may just be a nominal effect.
Yeah, well, and that's also true. That's the big thing. It's like, this is not a recessionary level. Igor Zegoluski says he has the answer. Okay, you ready for Igor Zegoluski? His answer? Is this Russian disinformation? Okay, Igor says people who work from home are getting 2 jobs on paycheck, and productivity is 0. That's why we have this nonsense. Payroll up, unemployment up. Hilarious. I mean, you're not wrong. In fact, there are some people who will get a remote job, and then they'll get another remote job, and they basically get another remote job, and they make it their job to get as many remote jobs as possible. And they'll sit there and have 4 or 5 remote jobs. This happened a lot during the pandemic. And they basically won't even work. They'll just wait to get fired. And as they wait to get fired, they're collecting the paycheck. And then it takes the companies like 4 or 5 months to realize that remote worker isn't actually performing their duties. And then they get fired. But in the meantime, they just got paid 5 jobs like for 5 months. And then they just kind of keep adding a new job at the end. So yeah, to some extent, remote work has some catching up to do with how we count it. So you're not wrong, Igor. But Igor says this is very bearish. And then Gary Roberts says Igor is a bot, and Not Steve says Igor is Polish, not Russian. Okay, whatever. I guess the point is, we got to look at the five-year break even. Let's pull that up really quick. But the point is, however you measure it, as weird and as rigged it feels, it's very hard to look at it and say with certainty it's 100% bearish. Like, even if people are working 2 jobs, fine. But then again, like I say, either way you look at it, it's like if you take out the multi-counting, then the Fed's job is working, right? If you take out the multi-counting by looking at the household survey, well, then the Fed just destroyed 330,000 jobs, or 310,000 jobs. So if you want to look at no multi-counting, the Fed just destroyed 310,000 jobs. So the Fed's doing a good job. If you want to look at the Fed avoiding a recession, well, then you could cite the payrolls report and go, the Fed just created 339,000 jobs. And then if you want to look at inflation, which is the important one, you look and go, inflation for wages are right at expectations and actually came in softer for the year over year and the month over month last month. You had a revision. The 5-year break even is like, I don't know what to think of this. Here's the 5-year break even, which just ticked up from 2.08. But dude, look at the trend. Like, yeah, really? Do we really care that the 5-year break even just ticked up 4 basis points? No. It is volatile. It has its little, 5 to 20 point moves all the time. You just want to pay attention to it to make sure it doesn't unanchor. See, and that's the big thing that regularly I would argue that everybody misses when it comes to, okay, Igor wants you to know he's Macedonian, not Polish or Russian. It's exactly what a Russian would say. Sorry. But anyway, so the big thing that essentially people are missing about the Fed is this idea that, the Fed has to get inflation down faster. And that's still above 2%, Kevin. No. What is the historical precedent of the Fed getting inflation down? Well, the historical precedent of the Fed getting inflation down is let's wait 20 years to get inflation down. That's what they did. After we got Paul Volcker, they waited 20 freaking years to get inflation down. So in that case, as long as inflation expectations are stable, the Fed's in no rush. And Jerome Powell could be like, I will have my tea and crumpets and be happy because I'm getting a building or a Mount Rushmore or something dedicated to me. Mm-hmm. This, by the way, is a massive Batman cup. What's kind of cool about it is it's got this really like badass handle right here. The only downside is when I hold that badass handle, you can't see it anymore. Then again, it's there. So, yeah, look, I know people say they're like, oh, but Kevin, you just always have a bullish bias. No, I don't. It certainly wasn't bullish about Rivian or the market. But this isn't that bad. From the most important thing that came out of this report, in my opinion, was the wage growth, because we do not want to see an inflation or wage price spiral. Remember what got me to flip-flop in the first place? If you go all the way back to the first flip-flop, Jan 2022, it was a wage price spiral. Nobody's talking about a wage price spiral anymore. Literally nobody is talking about a wage price spiral. Why is nobody talking about a wage price spiral? Because there is no wage price spiral. If anything, there's like a deflationary wage price spiral potentially going to happen because of AI. Like if you're not learning AI, you're getting left behind. That's why we're releasing all the AI lectures on June 6th at 6 p.m. Macy's, this was entertaining. I tweeted this part yesterday, but I want to point it out. Yesterday, we were going through some of retail's earnings calls in the course member live stream just to check what inflation is doing. That's what we do. We looked at Nordstrom, we looked at Macy's, you look at their earnings, you look at their earnings calls. We do this every day. We try to do fundamental analysis every single day the market is open. And Macy's, listen to what I wrote on the tweeters. You ready for this? You can look at my beautiful little yellow check mark. Isn't that nice? It's for our team. It's beautiful. It's shiny. It doesn't matter. Okay, so here. Macy's is literally trying to convince investors the markdowns and massive price reductions happening in stores are just following, quote, you ready for this? Here's Macy's explanation for markdowns and massive price reductions. Quote, we are following our enhanced pricing algorithms. We are following our pricing science tools. We are conducting promotions with precision. And we are simply updating our marketing messaging. In other words, our pricing is very robust. No, it's not. These are all euphemisms for we suck and prices are going down. But this is exactly what you would tell an investor in your earnings call because Macy's thinks you're stupid and thinks you're going to go, oh, yeah, you're dropping prices because you have enhanced pricing algorithms. Why don't you just come out and say you have AI to tell you need to drop prices? Because you know what? That would just make us really happy. You're dropping prices. Inflation's going away. It's crazy. It's crazy. So somebody here writes, Business Insider blamed AI for the people laid off. Maybe. There's no inflation going to the moon. Why is the bond market moving higher? So why would the bond market move higher on this? The bond market would move higher on this because the initial impression is that, oh, well, this means the Fed is going to have to keep rates higher for longer. Maybe not necessarily higher, but at least for longer. And the longer rates are up, the more people end up, the more you end up seeing bonds get dumped. And then when bonds get dumped, the price of those bonds go down and the yields go up. In other words, what you have to be compensated to stick your money into stupid bonds has to go up. The only reason you should put your money into bonds is if you really need the cash for something. Like you're going to go shopping for real estate. There's no way in hell if you're going to go shopping for real estate, you should really probably be speculating on, YOLO calls as the stock market. You just don't know. But otherwise your opportunity cost is massive to sit there and, I'm making 5%. Fine. But in addition to this explanation for why yields are going up, if you look at now the futures rate monitor yesterday, after the Fed leak that we were going to see a pause, you got this. Yesterday, we were at a 77% chance of a pause. After today's data, you're actually at a 66.9% chance of a pause. Fascinating. Steve says Macy's has AI, so it must be good. Yeah. Oh, that's a really interesting idea. Take these phrases, enhanced pricing algorithms and such, put them into ChatGPT and see what it thinks. Hey, ChatGPT, if a company used the following phrases to discuss price reductions and markdowns, are they trying to make investors feel good, or while actually facing a lack of pricing power? Or how should I interpret these phrases from Macy's in an investor earnings call? Paste. Okay, let's just see what it says together. These phrases are certainly trying to cast the company's pricing strategies in a positive light, as they tend to do in earnings calls. Each of them indicates a different aspect of their pricing and marketing strategies. Enhanced pricing algorithms. This implies the company is using advanced technology or data-driven methods to determine optimal pricing. Look at that. It suggests they're using AI to adjust prices. Okay. It could be about increasing prices where the market will bear it. Oh, you're saying there's hope. Pricing science tools is another way of saying they're using analytical methods to determine pricing. Promotions and precisions suggest their sales and promotions are targeted based on the data of consumer behaviors. Yeah, but all of this should be the default anyway. Updating marketing messages seems to indicate they're changing the way they communicate about their prices and promotions to customers. They may be trying to emphasize value. Well, that's exactly what everyone does when pricing is going down. While these phrases do suggest the company is using more sophisticated methods to set prices, they do not necessarily mean the company is facing a lack of pricing power. Yeah, I disagree. But okay. It could be that they're trying to use these methods to maximize profits in a competitive market. However, if these phrases are being used in conjunction with the news of lower than expected profits or revenue, yes, Macy's just dumped. Or if the company is generally struggling, the company just dumped. It could indeed be an attempt to make a bad situation seem better. Oh, that's actually kind of hilarious. This is what I like about the ChatGPT. I feel like you're almost kind of getting like your it's like an unbiased friend who's like, well, it could be this, it could be that. The only downside is like, well, which is it? Anyway, very cool. So there's the jobs data for you. Very fascinating. And now let's go chat about I don't know, something else. We can listen to CNBC for a second. I want to jump into a very interesting piece about talking about the history of artificial intelligence or innovation from a way of what does it do to the economy and what does it do to jobs. It's actually a really fascinating piece. So we'll go into that in just a moment. Do keep in mind after we get our work done this morning, we got to raise those prices on the programs on building your wealth. Or the increasing your income course, whether you're an employee or you're working for yourself, you're an entrepreneur, you want to see how to use AI actually productively in your business. You don't want to just get inundated with a stupid list of tools, but you actually want to see how can a real entrepreneur who faces real entrepreneurial challenges actually use artificial intelligence in their daily lives to be a better entrepreneur or employee. And that's what the How to Make More Money and Get SH9T Done Faster courses for. And then, of course, all of these come with lifetime access to the course member live streams and the updates that we do to them in the future. So check those out, link down below. We'll get that done. We are caught up on emails, but if you want to email us, send one to staff@meetkevin.com. And yeah, we'll be changing this soon. So now let's hop into, for a moment, what CNBC has to say. And then I want to show you this report because it's really cool. Let's listen in.
Checking the markets. Neither one of you or me. If you said 300 and whatever it was, 50,000 market state goes up 200, no way.
But you
No way.
No way.
Because you would have thought it'd be good to use bad news.
Right.
Yeah.
But
Did something change?
It's not all good news.
Or is it nuance?
I see unemployment rate up 0.3. I see temp jobs down 300K. I see average work week declining.
Sure. And you heard Plosser say it, they raise rates.
But they ain't gonna. The market is think they're gonna do a
I'll raise you a donut. I'll buy.
What
raise you
number
a
is
donut.
that?
Those are free.
That's like
those
number
are free.
six.
That's not a. Make sure you join us.
Happy National Donut Day.
Join us next week. Thanks, Kelly.
Thank you for having
Let's
me.
walk on the streets next.
I'll raise you a donut. Okay, so quickly also just looking again at I want to look again at what Wall Street is saying. You've got what do you have here? Prime age labor force, workers between 25 to 54 ticked up 0.1%. Okay, whatever. I mean, we've pretty much gone through this ad nauseum already. There's nothing else here. You have to wonder if those who are predicting a recession in the second half of the year are going to tweak their forecast. There it is. It's finally starting to happen. I think I've been saying for about at least a week now, I think we can reasonably say at least a week now, that this recession being predicted in the second half is definitely coming is going to end up getting revised to, okay, maybe it's not the second half, but it's gonna be Q1. But listen to this quote. You have to wonder if those predicting a recession in the second half of the year are going to tweak their forecasts. JP Morgan Chase economists have been in the camp of a mild recession in the second half of the year. I mean, the job market is going to need an abrupt decline this summer for that to be the case, it would seem. No sign here that we are on the verge of a recession. Right. Okay. We're going to get to the AI piece in just a moment, which is really, really cool. But let's listen in here for just a moment.
Down 164,000 over last month. People coming back. People realize they're going to have to go back to work because of student loans. I don't know. SNAP was cited repeatedly in the Dollar General. People don't get the food discounts. I don't know. Do people have to come back to work? I think that's why interest rates aren't soaring.
So that's the question you have, or you think you already got the answer to it?
No, I'm not as that presumptuous. I'm early. It's only a half hour. I'm trying to parse it.
Right. What does that mean for your view, though, of wages and wage inflation and how everything plays into that, and then hence into the Fed's
I continue to believe that Dollar General is the leader in this. The Dollar General says point blank that people have gotten much less, big deceleration in payments, having to go trading down. It's all happening. And
so there is consumer weakness.
Yes, because of
every
inflation.
day I feel like there's consumer weakness. Well, it's not that weak. It's kind of weak. Well, some are weak.
Okay, I'm trying to justify.
And then Carl will chime in with the delinquency numbers on credit cards, for example, which don't look great. Getting to the highest rate.
This is why I'm going for skip, because things are just so in flux. Come on. They're in flux.
Well, you got the household survey too, minus 310K, which I'm sure Goldman will talk about later today. As for wages, Jim, 4.3 annual is equal to the lowest since June of 21.
It's going in their direction. Do they have to push it even further? Do they? Let's say we're playing Jenga together, you and me. That's a game. Put the things higher.
I know it.
And it's like I pull this one out, okay? Then you pull 3 out. Mester. I'm never playing Jenga with Mester, man. You have to get. She's unless she really thinks she can not cause a recession and the whole thing won't fall. I don't believe it. She's off.
You think she's off?
She's off. All right. Well, there's Jimbo's reaction. That Mester is wrong. She's off, he says. Okay. This is an interesting one that I'm excited about. And I have to say, from a historical context, it's really entertaining. And you know, usually when people are like, oh, a history lesson, that's boring. This is a good one. It's all about AI. And, you know, is AI going to destroy jobs? And really, really cool. So let's just give you the gist of it, starting right now. Is AI going to ruin employment? Is everybody just going to lose their jobs and we're going to have to get universal basic income? Well, yes, potentially on needing to get stimulus. We're actually going to talk specifically about that in this video because Deutsche Bank just put together a piece on artificial intelligence. And listen to one of the hint, this is a part of what we're going to talk about towards the end of the video where we talk more about stimulus. But listen to this phrase here. Ready for this? In today's society, the tolerance for dramatic changes to people's employment prospects is low. So if the impact of AI is going to be transformative, then we could expect new laws, regulation, and there it is, folks. There it is. Stimulus in the near term, the financial support to reduce the near-term impact. Now, we're going to talk about this near-term income and stimulus towards the end because some people are going to go, how the HE double hockey sticks, Kevin, how the HE double hockey sticks, are we ever remotely going to go back to stimulus with these levels of debt? And I'm actually going to show you how exactly we might be able to. So first, though, we need to understand, is AI going to ruin all of our jobs and take away all of our opportunities? And is it time to destroy AI? And anybody who pitches AI, including you, Kevin, I see that course featuring AI. Well, let's read the Deutsche Bank piece, at least the highlights of it. So here we go. Given how rapidly the use of AI could spread, it is true that there could be short-term dislocations in the labor market. To date, though, the fears about technology leading to less work have been unfounded over the long term, since new technologies don't just substitute labor, but they actually tend to complement it. If anything, the biggest risk of innovation tends to be, quote, failing to embrace new technologies. In other words, if you're, and in fairness, a lot of people are like this, but if you're like a lot of people right now and you're like, AI schmai, it ain't doing my job right now, I don't need to learn about that. That is historically a big mistake. So maybe somebody can like help you out. You know, maybe there's somebody who can catch you up to speed in the link down below. Anyway, okay. So continuing on here. Since centuries prior to the Industrial Revolution demonstrate, stagnant productivity meant that living standards changed little. Now, I want to explain that. That's very interesting. But first, there's a really fascinating line right here. Where is it? Somewhere in here. I'm just going to jump to it because it's a really fascinating line before we get into some of these items here. In this Deutsche Bank piece, what they say is just 150 years ago, almost all of society had one purpose. And I want you to think about this for a moment because it's more impactful. So if you're just like passively listening, you're like, just tell me, Kevin, stop for a second and seriously ask yourself, what did most people do 150 years ago? What was the one goal people had 150 years ago? You ready for it? Get food on the table. That's it. 150 years ago, the vast majority of society existed literally to farm food and put that crap on the table while you're wearing some burlap clothing like you're in Rust and not running around naked. That was life 150 years ago. And it's scary that 150 years ago, everybody's working farms, where today, the size of our agricultural workforce is like zero relative to what everybody else does. I mean, the amount of farmers watching this video is probably somewhere like 1%. So if you're a farmer, you're the 1%. So that's very interesting because it shows you, okay, yeah, that's a good point. We have had technology and it has created a lot of new jobs over the last 150 years. We're not all grain farmers anymore, okay? So what has history looked like? Well, these are fascinating. So in 1589, Queen Elizabeth refused to grant the inventor of a mechanical knitting machine a patent because it would put manual knitters out of work, was the fear. Famously, in the 19th century, and I've regularly referred to this line in on this YouTube channel, the Luddites, or the phrase the Luddites. And specifically, I like to call people Luddites who just don't adapt. Like when I hear people are still storing stuff in paper files and binders, I'm like, Luddite. Why are you not? Why are you still doing that? I mean, unless you're like in the CIA or something like that. It's like, oh, we moved a bit of cloud. Or I don't know. It just seems wild. You're a Luddite. You're just not adapting with the times. But anyway, most famously in the early 19th century, a group of English textile workers called Luddites destroyed machinery, in part because of fears it would take away their jobs. To this day, the term Luddite is still used to those who are resistant to new approaches of working. Exactly. This is, yeah, I don't need to keep talking about Luddites, but that's one of the most frustrating things when you're running a company is when you're trying to hire people and then you hire people who are just completely resistant to doing things the more modern way. Anyway, you're better off training somebody who doesn't know what they're doing, how to do it better. Anyway, in 1862, you had union people form a union because grain elevators basically pissed off. Listen to this job. You ready for this job? Shovelers in New York City. Yes, shoveler was a job. And the shovelers would, quote, denounce the owners of elevators as capitalists and speculators who are robbing the honest laborer of his due. okay AOC of 1862. What actually ended up coming as a result of all of the innovation and all of this nonsensical fear of stuff like in the 1940, U.S. Senator Joseph O. Mahoney proposing a robot tax, that machines should be taxed in the proportion of the number of jobs they take away from humans. Or the Time magazine story of 1961 saying that basically new industries, yeah, in the past helped hire more people, but not anymore today. Now we're really going to start losing jobs. All of it ended up basically being complete BS. In fact, take a look at this. This right here is the Group of Seven's unemployment rate over the last 200 years, about. Actually, more like 250 years. You can basically see the unemployment rate has, with the exception of like booms and busts, pretty much stayed constantly low, like 3 to 4% over the last 250 years. Kind of wild. And here we are on Jobs Day talking about unemployment. So why hasn't there been a massive wave of unemployment anytime we get innovations? Well, look at this line. This one's particularly relevant. In centuries past, there were no cloud engineers. New jobs are created as the result of new technology. There were also no YouTubers, yet there are plenty today. Second, there are things that robots can't do, like persuasive argumentation. ChatGPT isn't great at being very persuasive, but it's pretty good at getting you baseline information that sometimes you still have to fact check. Number three, technologies increase our productivity and wealth, and they also increase our standard of living and also give us more free time, so that way we can demand other services like personal fitness trainers, which basically creates more jobs for personal fitness trainers. Think about it. If 150 years ago we're all farming, how many of us farming are like, oh yeah, let's now also get a personal fitness trainer? Like nobody. So you're like, I just had my personal fitness. It was called plowing. That's right. I plowed all day long. Anyway, so yeah, here's that example of 150 years ago. I thought that was really interesting. But anyway, now innovation leaves us open to more leisure and hospitality, better standard of living. Here's your agricultural industry. Agricultural industry plummeting over time, giving way to other services, leisure and hospitality, education and health. The more innovation you have, the more education you need. The more people need to understand how to type, how to use a computer, how to code. If there was no healthcare system in the past, because nobody knew what they were doing other than here, have some alcohol and bite on this rag while we chop your leg off, you don't really need much education. But now that we have a modern medical system, you actually do need to educate doctors for years, sometimes 6 to 10 years, which is wild. Shout out to the people who go through that for our healthcare system. Thank you. But anyway, then look at this. They give an example of Ford and the Model T. They're like, oh no, the conveyor belt is going to replace workers. AOC is going to be pissed of the early 1900s. Oh, wait, no. What did the conveyor belt system actually do? It actually reduced the cost of the vehicle from $950 in 1909 to just $290 by 1926, massively increasing the number of people who could afford a car, making them more productive because now more people could drive on newly built highways and go shopping in new strip malls or shopping centers that were built outside of cities. And they could live in suburbs and they could go to advanced schools and they could have more leisure time and they could build their wealth. Innovation is surprisingly a good thing. Surprise, surprise. In fact, look at this particular chart. This particular chart is, first of all, what's shocking is look at a time where we had little innovation. Between 1209 and 1709, you had basically negative real wage growth. In other words, if you were a worker in 1650, you made less money than the worker in 1209 because basically inflation reduced your real wage growth. That's insane. That 400 years later, you technically made less money. But that's because innovation was basically non-existent. Whereas when you actually put innovation into our society, look at what happened to real, which that's very important because real means inflation adjusted. What happened to inflation-adjusted earnings? They skyrocketed. What happened to productivity per person? It skyrocketed. Now, what's fascinating about this is there were estimates back in the day that basically people like John Maynard Keynes suggested that, hey, you know, not only are you going to have better health and you'll be able to live longer. I mean, look at this. Apparently today, we are 7 inches taller than our pre-industrial ancestors. So 150 years ago, people were 7 inches shorter. We're getting taller because of modern healthcare. Interesting. Never thought about that before. I understand the life expectancy has at least gone up. Maybe it's stagnated in recent years. In fact, that's what some people argue is like, oh, but well, we've stagnated since the Great Recession. True, but maybe now AI is actually going to help us get that next big boost, right? Unless, of course, you're a Luddite and you're like, leave me alone, AI. No, I don't want to learn about AI. No, I don't want to take the catch up to speed course from Kevin on featuring AI, which drops June 6th at 6 p.m. And yes, after Kevin finishes his work this morning, he's finally going to change those prices. And you can still email him at staff@meetkevin.com to lock in your best price before the prices go up. But anyway, going back to this, what's really interesting, and I love this stuff, is look at this. I'm just going to read this one because it's so fascinating to me. Even the most eminent economists have overestimated to the extent that which humans would find themselves underemployed as a result of economic progress. Back in 1930, John Maynard Keynes, famous Keynesian economist, he basically created that, wrote an essay called Economic Possibilities of Our Grandchildren. He predicted that living standards in the century would be 4 to 8 times higher, which actually proved to be correct. Living standards did go up 4 to 8 times. However, people didn't work less. See, he thought people would go down to just 15-hour work weeks because of innovation. That didn't happen, though. The work week hasn't really gone down that much. And the potential reason for the work week not going down that much is actually potentially because maybe work provides a sense of purpose and fulfillment. And that when you're unemployed, you actually have more negative health outcomes. You gain more weight, you're more unhealthy, you feel less happy, you're more depressed. But when you're working and you feel like you're actually contributing to real growth and you can make a meaningful change, that's actually what makes you most potentially happy. And now, that's would be on an average. That might not necessarily be true of everyone. But I thought this was interesting. Humans are inherently ambitious and will always seek out ways to progress themselves. So even if we all become richer in the future, individuals are unlikely to accept a good standard of living as defined in 2023. Instead, they will strive to, keep up with others, which will likely involve remaining in work to earn more money. As a result, even if some of our newfound wealth in the future is used to enjoy more leisure time, it is highly unlikely we see a complete one-to-one substitution of labor for leisure. In conclusion, if AI does prove, and then we got to talk stimulus, okay? And that's why I put this note here, because I knew I'd almost forget. If AI does prove disruptive, then it is to be expected that policymakers will protect workers against any short-term employment disruption, whether that is via laws, regulation, or a redistribution of income. Oh, that's interesting. So this is where we go to how the HE double hockey sticks. Are we ever remotely going to go back to stimulus with these high levels of debt that we face today? And what's actually the most simple explanation of how you can have stimulus with these high levels of debt is, quite frankly, the following. So write down what the level of debt is today. So we're going to write T equals, we'll just do T sub 0. T sub 0 will be time equals now, okay? So T sub 0, 31 trillion debt, 23, rounding a little bit here, trillion economy. That means we have a debt to GDP, using these numbers here, of about 134%. So we have more debt than our economy makes, right? That's bad. It's basically kind of like also saying we spend more than we take in, right? We're upside down. Now, let's go to T plus 10. So in other words, 10 years from now, What if in 10 years from now, because of the productivity that AI creates, in other words, people still work 40 hours a week, they're able to be so much more productive that they make more money and their wealth goes up, and hopefully they invest, like we talk about in the Stocks and Psychology of Money course or the Real Estate Zero to Millionaire course, whatever. That's how I went zero to millionaire way before YouTube, real estate. And people have more time to spend on stuff. Now, all of a sudden, you could, well, I suppose you could work more, but you could also spend more, which is cool. You could travel more or whatever. What if our economy explodes faster than the rate of debt? And with AI, this is likely to happen. So now all of a sudden, let's take our economy, and let's say our economy 10x's over the next 10 years. And so we go to $230 trillion of an economy. This is extreme. It's unlikely to 10x, but let's just make the math simple to understand how this could function. So say the economy 10x's over the next 10 years. Now your debt 5x's over the next 10 years. Okay. Well, 5x would put you at about 155 trillion in debt. Now, what is your debt to GDP? Well, now your debt to GDP ratio is actually just 67%. So now, what does this mean? Well, it means between now and 10 years from now, you could potentially spend 124 trillion more dollars, which basically is like 41 CARES Acts of stimulus. 41 CARES Acts of stimulus. And if I'm off by a factor of 10 here, then 4 CARES Acts. You see what I mean? But the point is to say, if the economy does become rapidly more productive, just like it has in history, right here, if this is what happens over the next 10 years, then as Deutsche Bank tells us, yes, you are going to likely see, quote, dislocations in labor markets, okay, in the short term. And those are going to be protected. How are those going to be protected? They are going to be protected with laws, regulation, or redistribution of income. In other words, likely some form of universal basic income, probably not called universal basic income because that's deemed too progressive or leftist, but something more like a higher unemployment insurance. Like, remember the days of, $500 a month? Or how about this one? You remember these days? Every American should be paid $2,000 a month at minimum just to be able to survive and put food on the table. Now, the problem with that is that going to cause massive inflation? Well, if you have this sort of productivity, not necessarily. Remember, let me catch you up to speed. What caused inflation during the pandemic? It was not the slow increase of spending. It was the sudden increase of spending. This spike is what caused inflation. You could fact check on me on this. This is very easy. All you have to do is type into Google St. Louis Fred and then type in, total Federal Reserve balance sheet. And then we could see basically the total assets of the Federal Reserve, which is a way of saying how much money did the Federal Reserve print. And if we look at the last 10 years, it's either relatively slow or negative. And you can do that right here. Relatively slow growth or negative. And if you look at this massive explosion here, well, no surprise that massive rapid explosion caused inflation. But if over the next 10 years, you do more of what we did during 2010 and 2018, where you gradually or more gradually spend more money on basically stimulative style programs for people who are being replaced by AI or some form of UBI, then what actually happens is you can, in a weird way, massively grow the economy while stimulating more and while not causing inflation. That is what we're going to leave it off on, because that is pretty wild to think about. That you can have UBI with no inflation and a more productive economy and a richer economy and one where people are more productive. However, you just have to remember the biggest warning that I think out of this piece was right here. the biggest risk would come from failing to embrace new technologies. That is exactly why you should embrace the How to Make More Money and Get SH&IT Done Faster course featuring AI, with the AI lectures dropping on June 6th at 6 p.m. We'll see you there.